Hello friends. Last week in my video, I advocated that the shorter week would basically help the bulls and look at where the market went up. Both the Nifty and the Bank Nifty almost kissed 2.5% gains on a week-on-week basis. Now, in this video, I have a special segment on what happens if the election outcome goes one way or the other. It's a very brief segment at the end of the video, so do stay with me till the fag end. Coming up on your screen right now is the market roundup window, which tells you that both the Nifty 50 and the Bank Nifty rose evenly. The US dollar index continued to fall, and that basically pushed up bullion prices very smartly. It was silver more than gold that has gone up, and I've been posting videos of my media interviews and columns that I write in newspapers and websites, where I've been advocating allocating 20% of your portfolio to bullion for long-term investors, and that is basically working out pretty well. The Indian rupee gained marginally against the dollar, and the Indian 10-year benchmark bond yield continued to rise. It rose 1 basis point and is now at 7.29%. Oil and gas continued to fall, which I have been telling you. I am not a believer in the super cycle theory or the aggressively optimistic talk about 100, 120 or $150 a barrel on crude oil. NSE gained market capitalization yet again, and the MWPL or market-wide position limits came down routinely post-expiry. US indices went up, with the Dow Jones leading the way forward, the Nasdaq and S&P 500 bringing up the rear. The market roundup done, I now come to our in-house indicators. Starting with the market-wide position limits, this is nothing but the extent of exposure utilized by the traders compared to what is totally allowed by the Securities and Exchange Board of India. Now, what you're seeing is the post-expiry low in MWPL at 29.36% is the highest in the last 4 previous expiries. That means post-expiry, the MWPL does tend to fall, but this fall is the smallest. Traders are showing tremendous amount of confidence in spite of the fact that election results are expected tomorrow. So risk appetite has definitely gone up. Now for the stock and index futures turnover, in spite of the fact that the week was a shorter one, the stock futures turnover has hit a period high in 20 weeks. Now, do remember, this is cumulative turnover of December, Jan and February futures series. The index futures turnover also went up, but nowhere as much as the stock futures turnover. Now coming to the advanced decline ratio, what you are seeing is the Nifty clocked 2.39% gains as shown as a red line, and the advanced decline ratio, which is an average of all 4 trading sessions of the week, went up to 1.11 as compared to the prior week's 0.96 rather. It tells you that for every 100 losers, there were 111 gainers. And the relative sentiments, relatively speaking, were showing higher buying conviction in spite of the short week. Now for the Nifty and Bank Nifty prompt month futures basis. Basis is nothing but the premium or discount prevalent to spot. It also is impacted by the time left to expiry. Now, since this is the beginning of the December series, traders have 4 weeks to play around with in the futures, and therefore they are willing to pay a high basis. But the premium paid on the Bank Nifty at 257 rupees and the Nifty 50 at 107 rupees is almost the period high. Is this lofty level of basis likely to last? I would bet not. These kind of readings are not sustainable, and as time to expiry approaches closer, Just like the options premium that is eroding with time, futures premium will also erode. So let's watch this on the daily updates which I put up on my social media accounts. Now, friends, for our in-house exclusive indicator, the impetus which you've trusted so much and almost for 3 years you banked on this, what we are seeing is that the Nifty and Bank Nifty impetus has on a weekly chart jumped smartly, which means that the price gains were accompanied by forceful and momentum based buying. That is always a welcome sign. And last week's rally, therefore, was led with was triggered with conviction. Now, friends, for another in-house exclusive indicator, the lift, weight, thrust, drag indicator, the LWTD indicator, what it tells you is that the Nifty might have gained 2.39%, but the LWTD actually fell. Now, it's fallen to minus 0.04 as compared to the prior week's 0.16. So from positive, it has fallen into negative territory. What does it tell you? That certain segment of the market seems to be a little concerned that the election results may just bring about a great degree of volatility. And like I told you, I have recorded a special segment at the fag end of this video. We are going to take it forward from there. But remain assured, the LWTD is basically telling you that some players are playing it safe. Friends, our in-house indicators done. I now come to the bond market, which I have been leading the broader markets by covering before equities, and I have been calling out rising cost of funds since October 2021, and that has basically been validated by the markets. Now, US Federal Reserve's Powell has basically dismissed the expectations of a rate cut in a hurry. That tells you that rates are not really likely to collapse or even come down marginally in the absolute near term. Do remember that our own RBI's Monetary Policy Committee is meeting on the 6th, 7th and 8th of December. The announcement about interest rate changes, if any, will be made on the 8th of December. So, the markets are basically very calm about the fact that the RBI Monetary Policy Committee is meeting, and the fact that bond yields have risen by 1 basis point. That means bond prices have come down just a little. I don't think bond markets are very particularly perturbed, anxious, nervous, or frightened about a rate hike. But sure enough, they are not expecting a rate cut as a major probability either. Now, look at the weekly chart of the Indian 10-year benchmark bond yield. We've basically edged up for the second week in a row, but we are nowhere close to a breakout above 7.5, 7.60%, beyond which I start laddering. But it's still not come down below the round number of 7% either, where I would go out and recommend gilt funds. So I'm still sitting on the fence, keeping the powder dry, checkbook ready, doing nothing. And remain assured, whenever I do, I will update it first and foremost on our Telegram channel, which is the single point source of all our views, thoughts, research, opinions, charts, etc., more than any other social media platform. So do connect with us there and make use of what I post there. Friends, the bond market's done. I now come to the Bank Nifty, which gained 2.39%, and the daily chart on your screen tells you that this index rose on 3 out of 4 trading sessions. The price is above the neckline, which is indicated as a blue rising trend line. The price is closed above the head and shoulders neckline and closed above it. The price is also above a month-long moving average, which means the short-term outlook is optimistic for now. The moving average itself is turning upwards. 44,600 is what I had advocated last week as a level above which the bulls will be better off. We've closed above that level, and so the short-term outlook seems to have improved substantially. Now let's take a look at the weekly chart. Number one, the price has closed above its 25-week exponential moving average after being below this average for 4 to 5 weeks in a row. And the 6-month long moving average is basically a medium term buy and hold investors proxy for holding on cost. So now the market price is above his holding on cost, so the selling pressure should reduce a little bit. Number two, we are also back in the Bank Nifty's bullish wedge formation, which is shown as two converging red color trend lines on your chart. So that basically tells you that if everything goes well with the elections, there is a possibility that bulls will take up the buy where they left off from on Friday, and they might just push the indices a little more higher. Now, in the week before last, this index was number 5 on the most volatile counters list as per the statistical beta rankings that we maintain in-house. It jumped 4 notches to number 1. That's not good news. A major sectoral index being the number 1 volatile counter in the market is not good news, because prices will jump up and down in a significantly erratic manner. Do remember, on 29th of November, I had alerted you on social media by putting out an update early in the morning before market hours that I expect volatility to jump up suddenly. Now, that was Wednesday morning. Wednesday markets rose with bigger gains. Thursday and Friday also you saw big gains. On your screen right now is the weekly chart of the Nifty along with the intra-week range of the Nifty itself. What you are seeing on this is that the range has suddenly got pulled significantly, like a rubber band being stretched to its maximum. You're almost at the high of the 20-week period where intra-week range gains are concerned. That means volatility is likely to be escalated. Now, if disappointment comes after elections, the unwinding will also be heavy. And if disappointment does not come and markets are happy with the election output, gains again will be big, and therefore short covering will come into play, thereby leading to higher volatility, which is what the chart significance is all about, which is why I updated that I expect volatility to go up as early as pre-market on Wednesday morning. So this is the advantage of having your own in-house statistical trading model. You basically get warning signs and good news far ahead of the crowds. So friends, what we basically saw was last week we advocated a range between 44,800 on the upside and 42,725 on the downside. Admittedly, my expected peak was overcome because the high was 44,951. It was my estimated target was overcome by 151 points. In the coming week, I estimate a range between 45,875 on the upside and 43,750 on the downside. Do also note our daily, weekly, and monthly pivot levels on the indices and commodities on our Telegram channel only. It's only updated there. It's absolutely free, so do make use of it, whether you're a futures or options trader, whether you're an intraday or a swing trader. It'll help you both ways. Friends, the Bank Nifty done. I now come to the Nifty 50, which gained exactly like the Bank Nifty, 2.39% on a week-on-week basis. But unlike the Bank Nifty, this index rose on all 4 trading sessions of the week, as you can see on the daily chart on your screen. The price has now entered a blue sky zone. Blue sky is all-time high, new high territory. And there is no fear of overhead supply. What is overhead supply? When selling emerges from bulls who are trapped at previously higher levels. Now, since the Nifty is at an all-time high, there are no previous high levels where bulls are stuck with longs, and they will come to sell when their break-even point comes. So, basically, selling pressure from previously trapped bulls will not be there. Profit taking from existing bulls might come, but that is expected to be thinner as compared to overhead supply. The price has run up above its month-long moving average, which itself is turning higher. My only concern is that the price is significantly higher than its moving average and there might be a mean reversion somewhat. And that could be triggered by the election results. So, volatility, like I said, is likely to be high because do remember the intra-week range, the chart of which I shared recently was basically telling you that it's time to be a little cautious where volatility is concerned. Now coming to the weekly chart on your screen, the price is comfortably above its 25-week exponential moving average, which is a 6-month long holding on cost of an average bull. So the medium term outlook is also optimistic. Price is at an all-time high. It's broken above the previous high, which is indicated by a maroon trend line. And what you are seeing is that the Nifty is therefore relatively looking stronger than the Bank Nifty because the chart is a lot more cleaner and positive. Friends, in the week before last, the Nifty 50 was number 10 on our most volatile counters list as per the statistical beta rankings in-house. It jumped 5 notches to number 5. Now that again tells you that challenge level for retail traders has gone up because they'll have to now face higher volatility. Now, last week, I advocated an estimated range between 20,175 on the upside and 19,425 on the downside. That was overcome because the high made by the Nifty was at 20,292. So, basically, what you are seeing is that both the indices have breached the expected resistance levels in the prior week. In the coming week, I estimate a range between 20,650 on the upside and 19,875 on the downside. Friends, a word of caution here. This is an emotionally charged week ahead where election results are going to be announced and therefore prices might exceed the price limits that I have specified. These are estimates, do remember. I use the word estimates here. They are likely to be exceeded in either direction. So let's be careful out there. And like I mentioned earlier, please do watch the daily, weekly and monthly pivot levels that I update for free only on our free Telegram channel. So do make use of this whether you're an options or futures trader, swing or intraday trader at all. Friends, I now come to the last bit of statistical analysis wherein I gauge the risk appetite of an average retail trader by the turnover contribution that he makes in the market. Now, in spite of the fact that it was a shorter week, what we are seeing is that index futures turnover indicated as a blue line on the weekly chart on your screen has gone up by 6 basis points. Stock futures turnover has risen very smartly by 35 basis points. It is indicated as a red line. So both index and stock futures, which demand the highest amount of capital from a trader, because compared to options, stocks demand the highest in terms of span margin, mark-to-market margin, exposure margin, ad hoc margins, extreme loss margins. And traders, in spite of the fact that they are required to pay all these margins, were actually trading more. So risk appetite, like the MWPL showed you, has indeed jumped very, very high. That is why the volatility has jumped. Now coming to the option segment, the lowest risk and the lowest volatility index security in the F&O space are index options. And that is where the turnover has collapsed by 84 basis points, as you can see on your screen as a green line. Now where stock options are concerned, there the turnover has gone up by 42 basis points. It is indicated as a purple line. So friends, number one, the highest risk instrument, which is stock and index futures, turnover has gone up. Within the option space, the higher of the two is stock options. There the turnover has gone up. So net, traders are basically in a very, very aggressive risk-taking mode. which is what I will discuss in the election outcome segment at the fag end of this video. Friends, I now start with my trading strategy for the week ahead, where I remain sanguine and cautious on oil and gas outlook. Sure enough, there could be pullback, rallies, and dead cat bounces. But as I use the word dead cat bounce, it's unlikely to sustain, because now there are again basically echo chambers which are chanting 100, 120, $130 a barrel after the OPEC has cut output afresh in the recent meeting. But I do feel that these counters are sell on rallies. Bullion might see some mild profit taking after a spectacular run up last week, because the Federal Reserve Chair Powell has basically indicated that he is in no hurry to cut interest rates. And the rally in bullion was partially triggered by expectations of a rate cut. Of course, a weak US dollar index helped. But net, I still remain positive for the outlook on bullion for patient delivery based long term investors. Do note how I've been sharing hyperlinks on my social media accounts about my media interactions, articles, etc. that I've written, that you must allocate at least 20% of your wealth in bullion. And the rally has basically taken gold to an all-time high, and I do expect silver to reach an all-time high, at least on the MCX, in short order. But like I said, this is for delivery-based investors and patient guys. This is not a trading call at all. If oil remains down, oil marketing company stocks may gain further ground, and metal stocks will basically mimic the underlying commodity prices on commodity exchanges. I will continue to focus on public sector units, and within the public sector units, I will focus more on public sector banks, because here volatility will be higher. My strategy for theta decay continues on energy counters in commodity exchanges, and also I will wait for election results tomorrow. I'm recording this video on Saturday. Election results are going to be announced on Sunday, and then I will take a call. Friends, I now start with the segment on elections that I had promised you. I will first of all admit that I am not a qualified psephologist. A psephologist is somebody who predicts and knows a lot about elections. I do not. So I am primarily a trader, and I will talk from the point of view of a trader. Now, unless the BJP loses in all major states like Madhya Pradesh, Rajasthan, and Chhattisgarh together, all three, the markets don't seem to be too worried. Do remember how a new high has been scaled on the Nifty on Friday itself. In spite of the fact that it's a weekend, in spite of the fact that election results are coming on Sunday, traders seem to be writing out big ticket checks. So basically, they are expecting the markets to continue with the same political equation. Telangana will not be much of a shock even if BJP loses, because BJP is weak in the south. Mizoram is a foregone conclusion because the BJP is not strong there either. The fact that traders have bet big money and MWPL has not fallen at all as much as what it has fallen in the last four post-expiry segments tells you that equilibrium to prices is more towards the upside than towards the downside. If the BJP suffers a change of fortune in all three states together, then there might be a disappointment that could trigger some amount of selling in the absolute near term. But I think over a period of time, this fall in prices will get bought into at lower levels, unless there is a very negative trigger from the international markets as well, which I have no way of predicting as of now. But over a period of time, I do expect shocks to get cushioned, because this is a market that seems to have made up its mind that it wants to go up. And unless some unforeseen circumstances come and deliver some unexpected shocks, I think the markets are likely to stay steady and even bullish. Friends, Before I wind up this video, a reminder to subscribe to my YouTube channel if you haven't already done so. And in the comment segment, do let me know how my videos are helping you become better traders and what you would want me to record in my next podcast. Also, help me to reach out to fellow like-minded smart traders like yourselves by sharing my videos as much as you can amongst your contact groups. I thank you for your patience in being with me in this video. Till we meet again in my next, this is Vijay Bhambwani signing off for now. Have a very, very profitable week ahead. Take care. Bye-bye.